In 2004, a gallon of milk felt ordinary. In 2024, it feels negotiated. A cart that once held a week of food now holds 4 days. Cereal costs more. Eggs swing wildly. Beef resets higher and never quite comes back down. You notice it in small ways. You switch brands, you buy less, you hesitate before reaching. Nothing dramatic, just friction. The headlines say inflation, supply chains, fuel, weather. And maybe that explains a spike. But it doesn't explain why the baseline moved. Why does every temporary shock seem to leave prices permanently higher? And if costs normalized, why didn't your receipt? That's the part that doesn't add up. The obvious story is simple. A pandemic disrupted global supply chains. Factories slowed, ports backed up, truck drivers were scarce. At the same time, demand surged. People stayed home. They cooked more. They stocked up. Energy prices rose. Fertilizer costs climbed. Animal feed became more expensive. Retailers passed those costs forward. That logic holds. When inputs rise, prices rise. When logistics break, shelves empty. When fuel spikes, transportation costs follow. And in 2022, food inflation surged across nearly every category. But here's where the pattern changes. Supply chains stabilized. Shipping rates fell. Fuel cooled. Labor markets normalized. Yet many grocery prices didn't return to pre-shock levels. That explains the moment, not the pattern. So if temporary costs faded, what kept the floor from falling back down? To see the pattern, you have to zoom out. Not just across time, across structure. Over the last 3 decades, the American food system consolidated. A handful of firms now process most of the nation's beef. A few poultry companies control hatcheries, feed, and distribution. 4 corporations dominate large segments of packaged goods across thousands of brands. On the retail side, giants like Walmart and Kroger anchor entire regional markets. That didn't happen during the pandemic. It happened long before. Small processors were acquired. Regional brands were absorbed. Independent grocers disappeared. Efficiency increased. Costs per unit fell. Margins stabilized. Investors rewarded scale. And when shocks hit, those concentrated systems didn't just pass through higher costs, they transmitted them, then held them. This isn't new. In the 1980s and 1990s, antitrust enforcement relaxed. Mergers accelerated. Food became less local, more centralized, more financialized. So when you ask, why did temporary shocks create permanent price shifts? You're no longer asking about trucks and fertilizer. You're asking about power density. Because when market share concentrates, pricing power does too. And here's the crystallization line. It wasn't the shortage that changed the price. It was the structure that decided where the price would land. That still doesn't answer the full question, but it changes where you're looking. Now the mechanism comes into focus. On the surface, grocery pricing looks reactive. Input costs rise. Producers adjust wholesale contracts. Retailers update shelf tags. Margins are preserved. That's the visible layer. But underneath it sits a reinforcing loop. Large processors negotiate from scale. Large retailers negotiate from scale. Both operate on thin margins but massive volume. When a shock raises costs, price increases move quickly through the chain. Consumers absorb the reset. Here's the part most people miss. When costs later fall, there is no symmetrical pressure forcing prices back down. Why? Because stabilizing revenue becomes the priority. Public companies are evaluated quarterly. Shareholders expect margin resilience. Executives are rewarded for protecting earnings consistency. So if higher prices don't meaningfully reduce volume, they become the new baseline. If volume holds at the higher price, revenue increases. If revenue increases, investor confidence stabilizes. If investor confidence stabilizes, capital remains cheap. And if capital remains cheap, expansion and consolidation continue. That's the reinforcing loop. Temporary cost shock, permanent margin test, baseline reset, consolidation strengthens, pricing power increases. This is the inevitability. If retail scale depends on margin stability and margin stability depends on price durability, then protecting higher prices protects the system itself. No conspiracy required. No coordinated meeting in a back room. Just aligned incentives. And here's the shareable line. Inflation didn't just raise food prices. It revealed which prices could survive without falling back. So return to the original question. Why didn't your receipt shrink when supply chains healed? Because the system didn't optimize for reversal. It optimized for stability. Go back to the cart, not the macro data, not the earnings call, the cart. You stand in the aisle, you adjust quietly. Maybe you switch from name brand to store brand. Maybe you buy chicken instead of beef. Maybe you put one item back. The system registers none of that as distress. It registers elasticity. And as long as total volume remains stable, the higher baseline holds. Remember the question. Why do temporary shocks, messy, leave permanent price marks? At first, it looked like logistics. Then, it looked like supply chains. Then, it looked like inflation. Now, it looks structural. Food didn't just get more expensive. Food became more capital sensitive. In a consolidated system, prices don't simply reflect cost, they reflect tolerance. Tolerance of shareholders, tolerance of consumers, tolerance of volume. And once a higher price proves survivable, it becomes stabilizing. That's the quiet gravity, not dramatic, not malicious, just self-reinforcing. The same consolidation that makes distribution efficient also makes reversals rare. The same scale that absorbs shocks also absorbs resistance. So when you look at your receipt again, the question isn't, why did this go up? It's, what would have to break for it to come back down? And in a system built to protect stability, breakage is the one thing it avoids.